In this video, I'm going to talk about where do banks get money to lend to home purchases. Obviously, each one of us have purchased a home at some point in time, and not all of us pay cash. So we must go to a bank to get money in order to buy the home. And one wonders where that money is coming from. Are banks just very capital intensive, or they also have their own source of funding? And that's what I'm going to unpack in this video. So here's my presentation that I have prepared. As you can see, the first slide talks about where do banks get money to lend for home purchases. So it's not just one vault of cash, it's just a funding system that bank has. And the simple answer to that, where the money is coming from, is following. The money is coming from deposits, capital of the bank, borrowing, and the secondary mortgage market. Secondary mortgage market is quite interesting. I was in banking and finance for about 25 years, and that's what I did at the banking. Basically, we would help other banks package their mortgages into pools, and then we would go out and sell at Wall Street, and Wall Street would create bonds would be issued to investors, and then investors would pay back the banks. And that was one of the biggest source also of how banks would replenish their cash. So we're going to touch on that a little bit. And on the second slide, it talks about mortgages funded from several pipes. Obviously, banks and lenders combine funding sources depending on cost, risk, liquidity, and whether they plan to hold or sell the loan. So one of the biggest source is the customer deposits. When you and I deposit our money into the bank and that money sits there, we don't use all of it, and we earn next to nothing interest, close to maybe less than 1% or 2% at most. Banks really take advantage of that money, and that money is sitting in checking, savings, and CDs, and the unused funds are lent out for other purposes by the bank, such as for the home loans, student loans, car loans, etc. The second source is the bank's own capital. This is the shareholders' equity, owner's equity, and the retained earnings. The third source is borrowed funds. Banks also borrow from Federal Home Loan Bank as well as Federal Reserve Bank, and they also have their own credit lines. Obviously, their credit lines are like ours, 100,000, 200,000, but instead they are in millions. And then there's a secondary market, which I talked about. Banks take all of their mortgages, they hire various investment banks, and they pool all the mortgages together, hundreds of mortgages put together into a bucket, and then they are sold on the Wall Street, where Wall Street basically issues bonds. Money comes in from investors and goes back to the bank. So deposits are usually the cheapest funding source for the bank. As I mentioned earlier, your checking, savings, and CDs help fund loans, but banks also must manage liquidity and capital requirements. Typical funding stack is such as this. You have deposit that make up about 55% of funding source. You have borrowing, which is about 20%. You got the secondary market where they pool the mortgages together and sell in the secondary market to investors. That's about 18%. And then there's the capital of the bank, meaning their own capital, which is about 7%. So as you can see, the cheapest source is the deposit, and that is the biggest source of funding banks financing. So banks create loans, then manage funding behind the scenes. When a loan closes, the bank records a mortgage asset on its balance sheet. It then funds that balance with a mix of deposits, capital, and market funding. So the bank balance sheet idea looks like this. They have a mortgage asset, which is a mortgage loan, and they fund it by deposits and borrowing capital. Okay. Key point here is the lending is constrained by credit quality, capital, liquidity, profitability, and regulation, not just cash in the vault. So even the credit quality of the bank itself matters. As you've seen, each institution has a credit rating, whether it's AA, AAA, double B, triple B, etc. So their credit quality also qualifies them for better financing, better the credit quality, better or favorable terms they get. Okay. Many mortgages are sold after closing. That's what I was talking about in the secondary market. Banks take their mortgages and sell to Wall Street, where Wall Street then funds back the money to the banks. Okay, and that's what that talks about here. Banks funds mortgage, loan is sold or securitized, investor buy cash flows, and cash returns to lender. Banks are very good money flow managers. For home buyers, the loan money usually comes from a mix of deposits from customers, bank capital, and liquidity reserves. borrowing from financial markets, selling loans into the secondary market. So the next time someone asks, where does the money, where does the bank get the money? Answer is from a funding engine, not a single pile of cash. I hope you enjoy the video.